Jimmy.
Hi.
Welcome.
Thanks for having me back.
Welcome. Every year Jimmy comes in. So we got a chapter block one today. Jimmy is going to talk about best practices in accounting, what you should be writing off, shouldn't be writing
Well, that
off.
was last year's, but we're talking about GST and stuff today.
Oh, I didn't get that.
Oh, no.
Is it
Okay, I'm
GST?
sorry. Yeah. I'll talk about still real estate related taxes.
Okay.
Yeah.
All right.
Yeah, but I can come back and do another
Well,
one.
thanks for letting me screw up again.
Sorry, Mike.
No worries. All right. So GST, and then and then we can ask questions after Jimmy's presentation for any other topic that you want. And I always encourage you guys to have a great accountant, one of the best. And then after Jimmy's done, the Klaus is going to talk about some property management tips and tricks and what's in the market. So, Jimmy, welcome back.
Thank you so much.
Good to see you, my friend.
Right on. Thank you for having me. Okay, I think I got a slide deck. I guess you guys want me to stand right here. Is that the idea?
As long as you can be seen on the camera.
Okay. All right then. Okay. All right. Well, thank you very much, everybody, for having me here. I really appreciate your time. I'll make sure to try not to bore you to death, but I do have some really important topics to talk about because the slide deck I've got today really is a result of a lot of questions that I've probably fielded over the last 6 months. And then I just make sure I remember them and then, come do a speaking engagement about it. Can we hit the next slide, please? Thank you. Now, before you do anything that we talk about today, please be advised that, the information I provide is intended to be generic in nature, all right? If you're going to do anything about the information I'm providing today, or if you're going to talk to your clients about anything, definitely have them reach out to their own accountant, or you reach out to your own accountant first. Please don't just act on anything that I talk about without talking to somebody about it first. Next slide, please. And I've been here before, but I definitely see some new faces. So I run an accounting practice along with 3 other partners of mine at Chief CPAs. We all kind of have our areas of practice and specialties. For me specifically, I specialize in real estate taxes. That covers everything from real estate agents to professional trades, other people who touch on to the industry, such as lawyers as well. And then I really enjoy working with real estate agents. So that's my core base, and hence that's why I'm here talking to you about real estate taxes today. Can we hit the next slide? So today, what I'm going to talk about are some rules around the BC speculation and vacancy tax. I'll cover the federal anti-flipping tax that's been around for a year now. And the BC anti-flipping tax has been in effect for a full year. And it's really starting to bite people in the butt. So I want to make sure that you're aware of those issues. And then, of course, GST issues on real estate is always a big one. So we'll cover those today, and then, of course, questions and wrap up towards the end. Next slide, please. And again.
You focus on his slide. I'll just share the Zoom. Yeah, it just disappeared here.
Oh, okay.
It's all good.
The taxes are no longer in effect.
Oh, that would be amazing.
There we go.
Okay. All right. So I think we're talking about. I think he jumped a couple of slides.
Where are we at now?
Oh yeah, BC speculation vacancy tax. And the next one. Okay, perfect. All right, here we go. So the BC speculation vacancy tax, we know it's supposed to target like foreign investors, right, who leave their properties empty. Now, the reality is it's caught a lot of unsuspecting homeowners, parents who have bought a place for their student child to live here while they're going to school, families who maybe are split families. One spouse lives somewhere else, another spouse lives here in Canada, and they're caught up in that as well too. So there's lots of unintended consequences, and the BC government hasn't really expressed any interest in rectifying those issues. They're supposed to be using those funds towards affordable housing. I'm not exactly sure where that money is going, but it is what it is. I'm not a politician. Next slide, please. So the taxable regions have been expanded last year in 2025. So it covers definitely some more areas. The ones on the right-hand side of the slide deck are the relatively new areas. I'll point out that Squamish and Lions Bay is part of it, right? Squamish for a while was not part of the BC speculation and vacancy tax. So, for those people who have clients that own properties out there it's a much bigger issue for them now as well too. Next slide, please. And the tax rates are going up effective January 1st, 2026. So it used to be 0.5% for BC residents, and then 2% for non-BC residents or non-Canadians, or those who are satellite families. And I'll talk about what a satellite family is in a bit. Those rates are going up to now 2% for non-Canadians and satellite families, and 3% for foreigners. Now, if you add up all the different layers of taxes, you have the BC speculation tax now at 3% for foreigners. You have the Vancouver empty homes tax if a Vancouver property at also 3%. And you also you used to have the underused housing tax, which actually got repealed effective December 31st, 2025. So we used to have 3 layers of kind of like a vacancy tax. We now are back to just 2. So a little bit of good news in the sense that the federal government's removed their underused housing tax.
And that was federal, right?
Yeah, the federal underused housing tax is the federal layer, and that was 1%. So it would have been 7% had the federal government decided, not to repeal. So they did repeal. If you have any foreign owners who were subject to the UHT tax before, you can give them some good news. A tax actually came off the table. Honestly, I don't remember the last time a tax came off the table, right? Okay, next slide, please. The satellite family is a concept that's really important to understand. In a nutshell, a satellite family is where you have a family. It could be a single person or it could be spouses together in a partnership. If more than half of their income is taxed in some other jurisdiction, not taxed in BC, much less Canada, then they are a satellite family. So the most common example I have of that would be spouses where one spouse works and lives in another country while the other spouse is here looking after children who are going to school here. And the main breadwinner of the family is the one living overseas. They are not a tax resident of BC, so they get their income taxed in some other jurisdiction. And the spouse that is living here has relatively low income because they're basically supported by the other spouse overseas. So you can see in a situation like that, the British Columbia income that is subject to taxes is less than 50% of the entire family net income. So that causes them to be a satellite family. Yes, Doug.
If the spouse was in Alberta working, would that same thing apply?
Well, it's still Canadian, so there is a slightly different tax rate for Canadian residents, but without BC income, so it's slightly different. You're probably going to be knocked down to that the BC rate, right?
Thanks.
Okay, next slide, please. Annual declarations, as we all know, happens every single year. It's happening at this time of the year. So right about now, everybody should be getting their letters from the BC government. So if you are a property owner, you will get one of these declarations. There's a declaration ID, there's a letter ID. You'll need those 2 numbers to be able to make that declaration. And your declaration will be due at the end of March. Next slide, please. There are lots of different exemptions. The most common one is if the property is used as your primary residence, okay? But if you're a satellite family, you can't use this exemption because, it's just the way that the rules work. So if it's your primary place of residence, you get an automatic out as long as you live in the property for at least 6 months out of the year. And it's also a place that you live in more so than anywhere else in the world. So it's a slightly different definition for primary residence under the BC speculation and vacancy tax. Next slide. The other exemption that you'll commonly have would be if you have a property that is occupied by a tenant. Now, there are 2 categories of tenants. You could have an arm's length tenant, so somebody who is completely unrelated to you, a normal tenancy in the usual sense of the word. And then you have what is called a non-arm's length tenancy. So the key is you have to have your property rented out for at least 6 months out of the year. You could have more than one tenancy that makes up that 6-month block, but each tenancy in and of itself must be at least 1 month or longer. So that doesn't cover like Airbnb, right? So that's an automatic out. You can't get an exemption under occupied by tenant if you're looking at short-term rentals of less than a month. Okay. Next slide, please. Thank you. With the non-arm's length tenant, this would be a situation where there is some sort of influence or control or maybe a disparity in the power dynamic of the relationship between landlord and tenant. So common example of that would be like between family members, uncles, nephews, nieces, cousins, etc. If it's a non-arm's length rental, there are a few additional conditions that need to be met. If the owner is a Canadian, lives here, works here, pays taxes here, all that is required is just a residential tenancy agreement. That's it. Okay. But if the landlord, the property owner, is a non-resident to Canada, a foreigner, in other words, then the non-arm's length tenant needs to meet an income test to ensure that the tenancy is exempt for the purpose of BC speculation and vacancy tax. So that income test is 3 times the fair market value of the rent. Okay, so it sounds really complicated, but it's really not. So for example, if the fair market value rent is $2,000 a month, then the non-arm's length tenant must have taxable income in BC of at least $6,000 a month. So 3 times the fair market value rent. Yes.
So if the son's living in the property with his girlfriend, can they combine their income?
Any one particular person. So no, not on a combined basis, right? And that assumes then if the son, then that means the parents are non-Canadians, right? Okay, all right. Any other questions so far?
Does the renter have to provide tax returns?
No, but if the BC Ministry of Finance were to come and audit the landlord, then the landlord's going to need to start coming up with some verifiable proof or whatever of source of income for the tenant. Because it's a non-arm's length tenancy, so you'd imagine it's quite easy for you to get that information. At least that's what the government thinks.
Yeah, it's getting a little ridiculous.
Yeah, it totally is. This has been around for a little while, but I'm finding that people, after taxes initially introduced, everybody's really gung-ho about it, so they'll learn about it, and then it dies down a little bit, and then people start getting caught up in it all over again. Okay.
And non-arms is immediate family, right?
Non-arm's length means a lot of different things, but it does include immediate family. It could include, like a little bit more of an extended family. It could also include employer and employee relationships, right? So anytime you have an
How
non-arm's
can
length.
they tell a nephew or a niece that has a different last name if they're non-arm's length?
Yeah,
It's a little ridiculous.
I suppose you couldn't really tell,
No.
right? No, you couldn't really tell.
It only becomes a problem if they audit.
Yes,
They're
bingo.
gonna figure out if they audit even. Were they gonna audit them and who are you and
Yeah.
who's your dad, who's your mom? It's a little crazy.
Yeah, it's,
When that do it.
Yeah.
I guess it is what it is so far, right? Yes.
Could this be triggered by the sale of the property?
In terms of a secondary review, like an audit.
I don't know, like, if they find out and then pull taxes. Yeah, I guess it's like.
Okay, so triggers for an audit, right? So triggers for an audit could be completely random. That's why that's just the nature of our honor-based tax system. So you'll just get audited randomly, right? Other triggers for audit would be if you haven't filed in a while, right? And then you file a whole bunch all at the same time. Well, they're probably going to want to look at least one of them, all right? If you sell the property, and I've seen this before, is you have a non-resident seller, they are supposed to apply for a clearance certificate with the Canada Revenue Agency. So that's a non-resident sale. And then you get the federal level government talking to the provincial level government, say, oh, hey, we've got, a non-resident seller. Have they paid all their, not just their federal tax, but their provincial tax as well too. So you do get that coming up, right? I used to find that the various levels of government don't really talk to each other, but everybody's starving for tax revenues right now, so they are talking to each other.
If they sell it and they're a foreigner, there's the 25% holdback tax.
Right.
Is there another provincial one?
No, there isn't a provincial holdback. The 25% withholding tax that you're talking about, Doug, is meant for the federal level government, but they'll tell the provincial level government, BC in our case, say, hey, there's been a non-resident sale. The UHT, when it was in effect, if you were taxable for the UHT, there's a very good chance you're taxable for the BC speculation and vacancy tax. So the departments will talk to each other, right? Yeah.
Okay.
Okay. Any other questions so far? No? Next slide, please. Oh, we talked a little bit about some other exemptions here. I'll leave that for the slide deck. I want to be mindful of time as well. Next slide. And if you have properties that are under development, so this will be for homeowners who are renovating their home and it's taking a lot longer than they expected. Complete teardowns will take, probably a good year or two to finish. So that is there for their benefit. A recent death of an owner will get you an exemption as well. So there's lots of other exemptions, and you'll be able to see, whatever else that you get. Next slide, please. Okay. Before we move on to federal anti-flipping tax rules, anybody have any questions on the BC spec tax? No? Okay, this one's a fun one too, because these two rules came into effect, well, effectively last year. So it's been around for a little while now. But it takes a while for people to get caught up on it because there's like a look back period. Okay. So once upon a time, when you sold a property, there was a lot that weighed on the intentions of the seller to determine if the property is a flipped property or it just happened to be that you sold it relatively soon after you bought it, right? There's a lot of subjectiveness there. So at the federal level, the Ministry of Finance has removed that subjectiveness and said any property that is sold, next slide. Any property that is sold within a year of purchase is subject to the federal anti-flipping tax. So it's effective for all sales that happen on or after January 1st, 2023, that are sold within a year of purchase. It flips the sale from a capital transaction into a business transaction. So if you're familiar with capital investments, you have a capital gain when there's a profit margin there, and you only pay taxes on half of the capital gain. In a business income transaction, you pay taxes on the entire margin, right? So, for example, if you sold a property for $1 million, but you bought it for 800, you have a capital gain of $200,000, and under the old set of rules, you would only pay taxes on half of that $200,000, so $100,000. But in a property where it's subject to the anti-flipping tax, the CRA reclassifies that income into business income, so that entire profit margin of $200,000 becomes taxable income, effectively doubling the taxes that you would have otherwise paid. Okay. Anybody have questions on that?
Who was the idiot that brought that one up?
Oh, I think that was Trudeau.
Yeah.
Yeah. Go ahead, Doug.
That applies to assignments as well.
Yes, it does apply to assignments as well. It does apply to assignments. So
Great question.
assignments is, well, we all know what assignments are. There's a profit margin in there. So it treats assignments as a flipped property.
Not always. Not always a profit. Sometimes they're
Yes.
negative now. So
Yeah, I will point out though that if you have a property that you sold within a year of buying, it does disallow the principal residence exemption. So if it was a property that you were living in and you would think you have a principal residence exemption, this disallows it. So no principal residence exemption. It also applies to assignment of pre-sale contracts. And if you close on the property, it resets that 1 year holding period, right? So if you've held the property for at least a year in that pre-sale phase, you're now out of the anti-flipping tax. But then a year later, so now you've held it for 2 years, instead of assigning it, you now complete and take the keys. It resets that holding period for the purposes of this tax.
So there's a period of time where it's beneficial, like if it's 366 days prior to the pre-sale,
Mhm.
that it would be beneficial to sell it then as a pre-sale rather than a resale.
Yeah, as an assignment
Because you
of
went through
a
the
pre-sale.
1 year.
Yeah, absolutely.
You wouldn't have to wait the other year.
Yes, correct. Yeah.
And I'll
Okay.
hold you to that.
Yes.
I'm kidding.
Oh,
So I'm gonna hold you to that, but you did the disclaimer at the beginning, so you're good.
so properties, I will note here that if you've had a property for more than a year, then you're into the old rules and this doesn't apply to you. Okay. Next slide, please. Then we have a usual set of exemptions. There's lots of reasons for why people would sell a property shortly after buying it. So, if somebody had died in the household or one of the owners had died, maybe you've got an addition to the home, so new baby, etc. Change in marital status, disability, change in employment, insolvency, or involuntary disposition, like maybe the government wants to build a road through your area and now they're expropriating your property. Okay.
That would be bankruptcy as well.
Insolvency, yeah, bankruptcy, yeah. Next slide, please.
I had that last year.
Okay. The BC anti-flipping tax, next slide, works in a very similar way to the federal anti-flipping tax, although this one is much more punitive. And it has a longer look back period of 2 years. So instead of 1 year, this has got a 2-year look back period. The tax applies to properties that are sold on or after January 1st, 2025, right? So today, if you were to sell a property today, it's the 21st of January. You're looking back 2 years. So if you've owned the property since January 21st, 2024, then you need to be mindful of the BC anti-flipping tax. Okay. It's only applicable to residential properties. So if you have a mixed use property, you have to segregate between the commercial and the residential use. The tax rate is 20% at its highest point. And then it declines on a prorated basis.
So
Yes.
as you get closer to that 2 years, it gets less?
Yes.
Oh, that's
Yes.
good. I like that.
Yeah. So it's not like an entirely straight line depreciation method. So in the first year, so from day 1 to day 365, it's 20% if you're caught under this rule. And then from day 366 to day 760, right? It would be on a declining basis,
Okay, good.
right? On a day per day basis. So you just take the number of days and then prorate like that.
Does this one reset itself when it sells as well?
If we're talking about an assignment, no, you do get to look at the entire holding period. So if you had it as an assignment initially, let's say 1 year in assignment, and then you take keys, right? So unlike the federal anti-flipping tax, you still get credit for that 1 year period while it was a pre-sale. You take the keys. So really you have to hold it for another year afterwards, right? So it'll look at your holding period during the pre-sale phase as well. Okay. Next slide, please. I mentioned already that the properties that this tax is applied to would be to housing units for residential use, not commercial properties. There are special rules for mixed-use properties. So again, it's just prorating. And there are some properties that are outright exempt. So things like properties on reserve lands, tree lands, self-governing indigenous bodies are not subject to the BC anti-flipping tax rules.
So all these leaseholds are not subject to any of this?
City of Vancouver leaseholds will still be subject, but your indigenous lands leaseholds would not be. Yeah.
Thank you.
Next slide, please. Okay. Any questions on the BC anti-flipping tax? Yes.
Recap here, because I'm totally lost. Okay, so the first portion, was that federal or provincial?
The first
The
one?
1 year.
Yeah, the 1 year was the federal level.
Okay, so can we just recap?
Yep.
Sorry.
No worries. Was there a specific question?
Yes. So the federal is 1 year, 365 days,
Yes.
20%, but 100% capital gain.
Okay, so the federal one, think of it as its own silo,
Yeah.
right? It's a 1 year look back period.
Okay.
And it just converts the tax treatment of your profit margin from a capital gain into a business income.
Okay.
And a capital gain, you would only pay taxes
50.
on half of it.
Right, but this is 100.
Right. And then the business income, you pay taxes on the entire profit margin. So in effect, it doubles your taxes.
Okay, and then do you also have 20% on the federal?
No. So that the federal is just
Okay.
the
got it.
treatment of the income, and then in a separate silo is your BC anti-flip tax, which is the 20%.
Which is 20%.
Right.
Both.
You could be hit with both.
Wait, is
Yeah.
20% of the lift or 20% of the?
Oh, that's a great question. That's a great question.
Kind of the left, but is
Yeah.
it also?
I'll get to yours in a bit. Pardon
Do you
me?
also pay capital gains?
So no, if it's a property that is subject to the federal anti-flipping tax, you're not paying like a capital gains tax because you are treating that as business income. So it'd be, it's a worse treatment, obviously, right? You're paying double the amount of taxes that you normally would because it's the income is treated as business income instead of a capital gain, right? Does that answer your question?
Yeah, I think so.
Okay.
Yeah.
It's double the tax. At the end of the day, that's
Yeah.
what people want to know is what happens to my taxes? Well, it doubles your taxes. Okay.
Yeah.
I want to go back to Doug's question of taxable income. So for the BC anti-flipping tax, they do have a formula that calculates what is the taxable income, like the profit margin on a flipped property. And it's 20% on that profit margin. So the profit margin allows you to account for sale price minus your cost, minus your transaction costs like legal fees, accountant's fees, realtor fees, those kind of deductions, renovations if you made any, etc. And then that gets you to your taxable income part, right? And that is 20% of that, or whatever prorated amount of 20% if you're selling it in the second year.
So if you actually lose money, there's no anti-flipping tax.
Yes. Yeah, because 20% or whatever of zero is still zero. Yeah. Yeah. Very good question.
The living taxes, they're for primary residents and for
All properties. Doesn't matter if it's your primary residence, vacation property, whatever property. If it's a residential property, it is subject to that. So you do need to be mindful of whether you're caught under that.
that your investment also pay capital tax.
Nope. So if it's an investment property, remember the capital gain will be flipped into business income.
Oh,
And then for the BC anti-flipping tax, it's a separate silo.
they're all
Like,
And for the federal silo, now does that person need a GST number?
that will be a different set of rules, which we'll cover in the next few slides. Okay. Yeah. So income tax is a different thing from GST, which is a different thing from BC anti-flipping tax, and you got all these various different taxes. So it's kind of like juggling, right? You got to be mindful of how many balls you got in the air, and which of those balls, kind of apply to you, right? Okay. So GST on real estate transactions. I'm getting a lot of questions about GST. It's died down a little bit, and then in the last 6 months, people are asking a bunch of questions of GST. So I figured you guys might want to have a little refresher on this. Can we go to the next slide? So we all know that GST is applicable on new residential property, right? That's all. That's not new news to you guys. It's not applicable on used residential properties, and a used residential property is a property that has not been occupied by the owner occupier as their primary residence, or any residence for that matter, and it hasn't been rented to somebody else by the property owner for that tenant to use as their place of residence. Okay. Next slide, please. Sorry, go back one up. I want to kind of reiterate a little bit. The common question I've got is when a buyer buys a property from the developer, maybe on a pre-sale or whatever the case would be. They got a brand new property, they pay GST to the developer, and for one reason or another, they're going to list it for sale, and the property is effectively new because they haven't occupied it, a tenant hasn't occupied it, they're basically turning around and flipping it for sale. Okay, so right off the bat, we know from my previous slide, the federal anti-flipping tax applies because that will treat that as a business income instead of capital gain. Now, whether it's applicable for the BC anti-flipping tax or not depends on how long they've held that property for, right? So if it's more than 2 years, not applicable. And then we have a different silo, the GST, all right? So when a property is effectively flipped, there's no occupancy, there's no primary residence, no rental. That property is still new property. So what looks like used property because somebody's bought it, they've registered, the first ownership on the land title records, it's still new residential property for the purposes of GST. So on that subsequent sale, the next one, that first buyer who is now the seller needs to charge GST to the second buyer. And that GST is collected by the first buyer who is now the seller and remitted to the CRA. Now, one might think that sounds a lot like double taxation because you're paid GST twice, right? But the reality is most people don't know is when you are engaged in a flipped property type transaction, indeed, it is a business transaction. You can register for a GST number. And in doing so, you can then claim a refund of the GST that was paid to the developer. You would offset that against the GST collected from the next buyer. And on a net basis, you would remit to the CRA the difference. So if you sold the property for a bit of a profit margin, obviously you would have collected more GST than the initial GST you paid to the developer. You'll just remit the net difference to the CRA. And if you sold the property for less than what you bought it for from the developer, you probably would have collected GST less than what you paid to the developer. You get a net refund. Okay, but you can only do that if you get a GST number. And if you're getting a GST number, you are admitting to the CRA and to all levels of government that this is indeed a flipped property transaction. You guys see how all that works and fits together? Okay. All right. Any questions on that before I move on to the next slide? Yes.
So if the listing agent, so you have your client on pre-sale, they complete and they want to list it on day one, with listing agent, what are you responsible for? GST applicable, and then the buyer's lawyer submits it, they,
No. So first responsibility is you tell your client you're at the listing agreement. It's like,
Yeah.
hey, I think you got a tax issue. You need to go and talk to an accountant, right?
Yeah.
And then they go and they talk to their accountant. But the responsibility for collecting GST is the seller's responsibility to collect.
okay, so their lawyer will collect it,
Right.
but the new buyer's in theory paying for it.
Yes.
So on the listing, GST is applicable,
Yes.
so that's our responsibility, GST is applicable. So then how are they collecting it? They're paying it, the new buyer's paying it.
Yeah. It all happens through the statement of adjustments. So for
Okay,
example,
so
yeah.
that, so that goes back to the lawyers.
Yes, it goes
Thank
back
you.
like in terms
So
of the
it's-
actual collection.
GST applicable, lawyers deal with that.
Yes.
Thank you. Okay.
Yes, yeah. I will also point out though that in a normal course of business, when you buy something, you pay GST on top of your purchase price, right?
Right,
But if you'll notice on your standard, contracts of purchase and sale, there is a clause on there that says if GST is applicable, it's included in the purchase price,
right.
right? So as a listing agent, if you know or are told that GST is applicable, you have to remind your client that, hey, if you're selling this property for listing price of $1 million, you're not actually getting $1 million because about $50,000 of that is going to go to the CRA,
Right.
right? And they need to do a GST return and all this other stuff. So they're really getting like 952 plus GST
Right.
equals $1 million.
So if the new buyer's realtor puts in the GST included clause in the contract.
Oh, it's in there by standard. Like I'm pretty sure it's in there.
It is, yeah.
It is, right? That was changed last year.
Yeah.
Yeah, so it's in
All
there.
of them
It's
say
baked in there.
GST.
They just
Yeah.
cross it out.
Okay, you could negotiate your way out of that, but if I was a buyer and you crossed out that clause, or maybe I crossed it out because I'm smart like that, then that brings up a conversation. Oh, why'd you cross it out, right?
Make it into price.
Yeah, you got to make it into the price.
But is the new buyer on the increased value or the
On the increased value, so whatever is the purchase price, that's the GST included amount, and that will be whatever's the new value, right?
Okay.
Yeah. Okay.
Also, you guys don't get paid commission on the GST, okay?
That's a good point. Okay, next slide, please. Substantially renovated properties. I don't come across this too much anymore, but there was a point in time where a lot of like real estate investors were converting, or not converting, that's the wrong word to use, renovating like your Vancouver special homes. We all know what a Vancouver special looks like, right? And then you walk in, it's like completely different. It's all done out. The layout's all changed. They completely gutted it out. So when you walk into a sale of a used property, but it doesn't look anything like it was originally, there's always a potential that GST applies, because when you are substantially renovating a property, and I'll talk about what substantially renovated means, but when you substantially renovate a property and the idea is you're doing that for profit, then you as the renovator are a builder for the purposes of GST. And when you're selling that property, you have to collect GST from the next buyer because you have now converted used residential property into new residential property. Okay, so that's the crux of the issue. What does substantially renovated mean? It means this arbitrary number of 90% or more of the property has been renovated. Well, 90% of what? Well, you can use square footage, you can use number of, rooms. Square footage is the most common one, right? But aside from all those metrics, right? And when you walk into a home and it looks nothing like it's supposed to look, and it's very different now, it looks very new, all you got to do is wonder, I wonder if this is now considered new property for the purposes of GST. And if you are the buyer's agent, you just got to ask the listing agent, hey, is this new property for GST? Right? I guess with now that baked in clause of GST being included, it's not really an issue anymore, right? Yeah, it's not really an issue. But as a listing agent, you will need to know if this is going to be applicable for GST, because your seller is going to be out that 5%. So you need to maybe bump up your listing price a little bit to account for that, right? Yeah.
If they live in the property after renovating, is that?
Oh, if they're living, if then they wouldn't be renovating for profit. They're renovating for their own personal use, so they're not a builder for GST purposes there.
Is there a time frame? So say you did a reno over 90%, you lived there for 2 years, then you sold?
Oh, that's such a great question. Very, very good question. There is not a specific time frame, right? If the seller is unfortunate enough to get audited, the CRA will look at the circumstantial evidence, right? So, did you have your typical long-term mortgage, or were you on an open mortgage, right? How long did you live there? I mean, that's only one factor. It's not make or break. They'll also look at, why did you decide to sell, right? If you had some sort of life-changing event, a death or whatever, right? Or maybe you got a new job and you had to move. That's a very reasonable, explanation for why you're selling so soon after you just renovated it. So it's very circumstantial up to the facts of the case.
So it's great.
Yeah, super great. Yeah. Okay. Next slide, please. Laneway homes. I know a lot of people have built laneway homes. I will say, if you build a laneway home for your own personal use, you don't have an issue. Okay. So if you build a laneway home for your in-laws to live in, for your kids to live in, you don't have an issue. That is a personal use project. If you build a laneway home for the purposes of earning rental income, that is an income producing intention, right? And when you build a laneway home for income producing purposes, and its first use after you build that laneway home is you put a tenant in there and start earning money on it, you've now tripped over a GST issue, where effectively the CRA wants you to segregate the value of your home between the laneway portion and the main part of the home, even though the two are not stratified, right? It's one property. They still expect you to split it out and then charge yourself GST on the newly addition laneway home. Okay. And then as a knock-on effect, when you go to sell the home later, you now have a home that is not entirely your principal residence, right? Because the main home is your principal residence. Your secondary building is an income-producing building. You don't get a principal residence exemption on that secondary use building. Okay. All right.
Unless it's for family.
Unless it's for family, which of course is a personal use. Yeah. So again, if you're building for your own personal use, it's not an issue at all. It's not a GST issue. It's not a principal residence issue. It's only when you're building it for the purpose of earning rental income. But honestly, most people are building laneways for the purposes of earning rental income, right? Yeah. Okay, next slide, please. Short-term rental operators, clearly it's GST taxable, but if you are listing your place on Airbnb, for example, or Verbo or any of the other websites for short-term rentals, the online marketplace facilitator, which is Airbnb or Verbo, they're the ones collecting GST and reporting that for the property owners. So effectively, you don't have to manage it yourself. Okay. But if you are earning more than $30,000 in a year, you are required to register for a GST account and manage the GST yourself. And then Airbnb is supposed to be paying you out that GST as opposed to claiming it as their own. Okay.
Have you dealt with any of those?
Oh, all the time.
And are they paying it on a regular, like?
No, Airbnb has no clue what they're doing.
Yeah. All the same?
Yeah, I don't have too many verbal clients, right?
Just kind of getting that feeling right now. Not sure if they know what the hell they're doing.
No, Airbnb has no clue what they're doing because they're only used to dealing with your regular person who's Airbnb there. Well, you're supposed to only Airbnb your principal residence, that secondary room, right? So Airbnb is accustomed to working with people whose rental income is less than 30. So GST doesn't become an issue for those owners, nor is it for Airbnb because they will just charge the GST to the guests and they will remit GST as if it was their own and everybody's fine. But for those property owners who exceed $30,000 of rental income, they've got a GST liability. They're supposed to retain that GST for themselves, remit it to the CRA, file a GST return, right? But Airbnb, when you get something like that, they're just not used to people saying, I've got a GST number, send me the GST instead, so I can remit to the CRA on my own GST number.
Yeah, it's kind of scary.
Yeah. So a lot of times the property owners are just out that GST because Airbnb is not giving it to them, right? Yeah, but there are odd cases where Airbnb does do it right? But it's at the insistence of the property owner. They don't do it for all property owners.
You gotta watch them.
Yeah, so you really gotta watch. Okay, next slide, please. I think the last one here is GST on assignment of pre-sales. So we have a deeming rule now for a number of years. It was very subjective. For the last couple of years, the CRA had rolled out a rule that just simply said GST is applicable on all assignment of pre-sale contracts, and GST is applicable only on the lift. Okay, so it's a lot simpler now than it used to be, right? And it will always be applicable, the GST on assignments. So it removes a lot of the speculation, a lot of the subjectivity. It really puts you guys in a much better place because now you're not having to coach clients through, the subjective nature of whether GST applies or not. GST does apply to assignments and it only applies on the lift. Okay. Yes.
It's the first time we're.
Whether it's a first-time home buyer. So if you're buying a property and you're paying GST on the lift, you may or may not be eligible for a GST rebate. There are qualifying criteria that goes into that, including, of course, the purchase price of the property as well too. And you're paying GST twice, right? Because once initially to the assignor on the lift, and you're paying a GST again to the developer on the original contract price. So I don't think you can make two separate GST rebate applications, but you will need to kind of navigate through that if, of course, you qualify. Okay, and I think that is my last slide. Next slide should be like questions or something like that. So yeah, if anybody has any questions, let me know. I'll stick around for a little while longer. Otherwise, my phone number, email address, and website is there for you to reach me afterwards. Thank you very much, everybody.
Thank you. So, I love his disclaimer at the beginning, which you all should use because we're not accountants and we're not lawyers. Make sure that your customer realizes that and direct them to Jimmy. He did us a big favor by coming in, and obviously I recommend him as an accountant for you and for your customers. So thank you again, my friend. Before Klaus gets up here, I'd like to welcome Catherine Footy to the office. It only took me what, 3 years? 3 years to get her to join us, but she's coming from Sutton up the street and she's living around the corner. So welcome. And then we have a special guest, Tricia Houlihan.
Very special.
Well, special enough. The Deep Cove Realtor wanted to come in and hear what Jimmy had to say, and a good friend of ours. So welcome to the meeting. Thank you. Where's Klaus? Here around here somewhere? Come on. You can't do it from back there. Klaus wants to talk about property management. We raised the questions. Yep. And he's our backup broker.
Backup broker, yes. Actually, I just wanted to make a quick note for rentals. As you know, speculation tax and empty home tax time is going to come up soon. And it's going to take right now about 2 to 3 months to rent any property in the city. So your sellers need to be aware of that. So if they are planning to rent out their property, would be a good time to probably list it for rent the end of February. So that we have enough lead up time to actually get somebody in there. So when the listing comes off, that they are covered for the speculative vacant home tax. If you've got any questions or need a property assessment, you can call us or Amanda. And more than happy to help. Other than that, rental market downtown has stabilized, but in the suburbs, it's still going down a little bit. We've seen still decreases in comfort level, Port Moody, and in Surrey.
You're talking about price or just
Rental prices, yeah.
price? How are you finding tenants downtown? Just on average, one bedroom. It used to be like
It's a little hard. It's like I said, it's taking us about two months to get a good one. Yeah. Well, there's a lot more inventory out there and a lot less demand. But prices seem to have stabilized. So we're sitting at about 2,500 for one bedrooms now.
Yeah. So has the demand shifted from here? Kind of.
It did originally, but now it's coming back because I think a lot of it has to do with coming back to the office rules for offices. So we're getting people from Microsoft now, from some of the offices downtown. But people are moving back because they have to be in the office.
We're speaking of Microsoft. Are they kind of moving out or something? Because I heard Lululemon's moving into where they
did.
reducing?
They had, what was it, Amanda, correct me if I'm wrong, 2,000 layoffs, I think? Yeah, that was a few months ago. That was October. That's when we really
they downsized a little bit.
Yeah. But they're now starting to bring people back in, and we're starting to see people relocating from the States into Vancouver. For, I would think, obvious reasons, but.
Same with Amazon. Amazon usually did a big hire. They haven't done one in a long time, and we just have somebody now applying,
Yeah.
coming from Seattle.
Yeah.
Back to Vancouver, so it's probably been, since like last November, like a good almost year.
Yeah.
For Amazon hires.
So.
Yeah.
Good, thanks.
All right, thanks, folks.
That's it. All right.
Oh, and one more thing, Catherine, you have 2 listings you're bringing to the office. Where are your listings?
Richmond and here.
So you've got a small 1-bedroom in Richmond.
Yeah.
And-
It's rips sort of just Elmbridge Way.
Okay, and then we'll post those up. And then what's the one here?
It's 198 Chris.
198 Aquarius Muse. So we'll post that up so you guys can see it. Be really nice for her to come to the office and one of us sell the listing, right? That's what our job is. But welcome again. Jimmy?
Yeah.
Good.
Thank
Thank you. Doug, do you have any final words?
I'm good, Mike.
Guys, have a great week. If you need me, give me a call. Thanks.
Thank you.